I'm the most bullish in commodities, and I will say this to everyone, it is the hardest to hold because they're the most volatile. Decades happen in years. So you can take advantage of that when these things really start to go. You can find great companies that are really, really low that has nothing to do with the company. Commodities are different because the commodity determines the margins of the companies. When the commodity falls really low, you can buy really, really good companies, well-ran companies for pennies on the dollar. I can't find that anywhere else in the market.
Hello, welcome to the next big rush. I have here Andy from Finding Value Finance again on the show because he is a household favorite, and we're here to talk commodities. I want to get into like all the stuff that people actually want to know, like price predictions, stocks that are sucking right now, stocks that are doing great right now, maybe picks that you have for your folks that have worked out really well. Andy, what are you seeing out there that you find interesting that you think that investors should take a look at that maybe they aren't right now?
Yeah, the obvious stuff right now, and everyone's real hot on it, gold, silver, and then platinum's going to go and break out next. And then palladium's been kind of surging higher there. So I think that's kind of where the majority of people are excited about at this exact moment. Gold's been, it's been ripping. 2780 is what I'm seeing around that area. And that looks good to continue higher. The momentum's definitely to the upside. So that's where everyone's looking. I think there's opportunities there, and especially in silver, like some of these silver companies, silver junior companies, even gold. There's gold opportunities there too, and then platinum group metals, definitely opportunities. We're just about to break out on platinum any
Okay, that
second
that's
here.
that's that's a big claim. We're just about to break on platinum. What makes you so certain? I have my own thoughts that I might have mentioned in a talk, VRIC, like almost a year ago, but I'd
Mhm.
like to have your input.
Yeah, so I'll just show you. So gold's the leader.
Please do.
Gold's been going vertical, getting jiggy with it, is what I'll say.
I love that.
Silver, I think, is a little bit behind it. So silver, we've got the same kind of fractal, and when I talk fractals, I'll just show you what I mean by this. So here's kind of this pattern there. Do you see that pattern here? This guy right
Yep.
there.
Yep.
You can see the same fractal setup, which is right here
Mm-hmm.
on silver. Of course, it blows it all the way up. Let me see if I can shrink it real quick. And let me do something real
Looks like
quick.
some weird sideways action. It kind of pretends to go down and then breaks to the upside. Am I reading that right?
Yeah, yeah. So I'll describe what a fractal is here real quick. I'm just trying to show you guys if I can shrink it down enough. So this fractal, what a fractal is it's humans interacting with each other, creating these patterns. And the gold pattern, just to kind of show you what the fractal kind of looks like there. We're going through it right now in silver.
Wow.
We're just delayed behind it.
Mm-hmm.
These fractals are humans being subjected to certain market conditions, and they behave over and over and over in history repeatedly using well, just repeatedly as a herd. They repeat these patterns. And I'm not saying that I'm a fractal specialist, but I do look at that to see if it repeats and what it looks like. And this to me, silver just looks like it's a lagged gold, and it's got a lot of leverage to the price move to the upside. So if I were to choose, if someone were to say, are you more bullish on gold or silver? Well, right now I would choose silver because we're breaking out and it's got that fractal pattern that gold had before it really started to rip. Plus, just look at this big picture here. This is silver over a long, long period of time. Back in the 1970s, we've got what's considered to be a cup and a handle. And if I were to zoom out and show you kind of the price projection, and I don't get too focused on the price projection. Focus on how big the pattern is and things are breaking to the upside. That's what I focus on.
Okay.
But we have broken the handle portion of silver.
Mhm.
So what this is indicating is that silver could move a very long way to the upside. There's a ton of runway ahead of us. And with the fractal and how these things are all aligning with this pattern of the cup and handle here, you could also say that this is another, cup and handle that could potentially form. I think this looks absolutely excellent, and I would have some exposure to it. Talking a little bit about strategy, it's not about putting all your money in one sector and getting that one sector right, although concentration can definitely get you wealthy overnight or get you wealthy quicker. But it does leave you to a lot of risk if the market conditions change for a period of time and things kind of move against you for a period of time, and people psychologically struggle to hold on to these things. So the way that I look at this is one area that I would allocate to from an overall portfolio. Because of the symmetry here, it's so absolutely lopsided in favor of a very large move upside for silver. I mean,
And
it's
you're
big.
going back to like the 70s. So this is something that you should also consider when you're looking at this. Like this is not, a minute chart on the last 2 weeks or something like that. Like this is going back, to the first, massive bull market in silver of modern history. And then, the second one back in 2011. So that I'm assuming that means that you should also take a long-term view when if you go in now expecting a bump to the upside. If you're looking at that ridiculous 349 level that you have marked there, I don't know if you did that on purpose or if it's just there by accident, but not to give up on something like this if it doesn't turn out in like a month or so. Am I right?
So the bigger the pattern, the bigger the move, and then this pattern is so big that it's probably going to take a decade or longer to play out in. It's going to take some time. It doesn't mean that it can't hit this level very quickly. We don't know that. But if I were to take a guess, and here's just my guess, and guys, don't hold me to it. This isn't a prediction, but I'm guessing that we'll break through 50 or so, something like that, and then we'll probably retest it, and then we'll break out. So that would be my best guess.
Mm-hmm.
And these resistance levels somewhere in the vicinity of where we're at, we're going to get stuck for a little bit at some point. And think of it as like taking turns of certain sectors doing well under rising interest rates, high inflation. It cools off. We get a little bit of a slowdown. Then gold takes off. It'll cycle back and forth, but it'll be making higher highs and higher lows as the market conditions cycle back and forth. So hopefully that makes sense to you guys. Things don't go up in a straight line. They go in waves or cycles,
Mm-hmm.
and you just have to be. I'll put it this way: we've got a changing paradigm. We'll talk about it right here. Interest rates are a big driver a lot of this, and I'm just going to make it so it's easier to see. You've got these interest rate movements. You go from an declining interest rate environment, increasing interest rate environment, declining interest rate environment, and then I'm in the opinion that we're in an increasing interest rate environment, and that bottomed in 2022. So I think that this is a driver of people not wanting to own bonds, and then they're going to look at gold, they're going to look at silver, and they're going to prefer those assets. So if I were to put up, let me see, let me do this, XAU USD. I think that's got a long history, I think. Yeah, blow it up. So a lot of these, this is just gold. They do real well, and this was a gold standard, so this is all fixed. But when interest rates went up, gold went up. And then notice when interest rates went down, we went into a huge consolidation. Yeah, it went up a little bit here, but we were still consolidating, and now we've broken out. I think this interest rate move here is a bigger deal than what most people attribute to it. So I think the unwillingness for people to want to hold bonds from individual perspectives and from countries' perspectives is going to drive gold way up there. It's also going to drive silver. It's going to drive anything that's precious metals related, because they view these assets as less risk than holding other countries' bonds. So I think that's a big deal. And with where they are priced from a ratio perspective against other assets, it's kind of a no-brainer, in my opinion, to have an allocation, a large allocation to metals, physical metals, the stuff that you drop on your feet, not the ETFs that you can't drop on your feet. So I think it's all coming, and it's going to be a big bull market. I don't know if it's going to be like a game-ending blow to the currency or
Mm-hmm.
not. A lot of people say that the currency is going to, go to it's game ending and it's going to go to zero. I don't know that. All I know is it's cheap. We've got a paradigm shift in the interest rates. I think we're going into an increasing interest rate environment. It's going to last for a while. Gold and silver, silver's got the biggest cup and handle pattern I've ever seen of anything. So I think with all of that set up in alignment, I think it'd be a good place to allocate some money for a portion of the portfolio. Is the way I would say it.
Cool. And what about platinum?
Well, so platinum's looking fantastic. Platinum is more correlated to oil than what most people think. So I'm just going to make a comment. Gold and silver, gold's it does well in a different market condition than platinum and oil. So what you'll see in history is you'll see gold and silver rip it when we get a slowdown, when the yield curve uninverts. So when the yield curve kind of rolls over and starts uninverting, that's when gold and silver. So think of them as like the anticipation of money printing is the way that I would say it. Platinum and oil are inflation sensitive. They're more sensitive to inflation coming through the system, not anticipating that inflation. So gold is the ultimate anticipator. It is the liquidity sensitivity measuring stick. Silver acts along with gold with a lag, and then platinum and oil are very similar, and that's when that inflation comes through the system. So you can see that these are very similar in terms of their chart patterns and how they react. So oil does what gold does with like a 500-day lag or something like that, 566-day lag. And then platinum is very similar to that. You can almost see the exact movements are there. So platinum is just starting to break out. I had it on a candlestick here. And what I did is I just took the tops of it, ran it across, and we're just starting to break out just recently, like today. You can also throw another candlestick here on the closing prices, which tightens it up. And we've definitely broken out of that. So I think platinum is an incredible opportunity for investment, for an allocation to, because of the situation we're in here. So silver's got the gigantic big 45-year chart that can just, I mean, it can rip. This thing also from 2008 squeezed on up, and I think the way that I view it is your squeeze is actually this. You get a three hump consolidation. Then we went sideways a little bit with 2020, and then we broke out here, did a retest, and we've just been moving sideways, waiting for the right market conditions to come. It's the same setup that we have back here. This is this. It's the same setup if you were to look at it. I can even make it a little bit easier if you guys want to see how this correlates. I can just grab it. That's that fractal that I talk about. And then you can see it. Now it's going to be scrunched up more. So I'm going to elongate it. So this kind of three hump fractal is that guy there, if you guys can see that. And then the right hand side is all scrunched up, which
Mm-hmm.
is that stuff.
Yeah.
It's all
Yeah, yeah.
scrunched up here.
I
Yeah,
can
so
see
that
it.
fractal, it's the same setup. And then you can see what this setup produced was a big move. And I think that is coming. I also think that's coming because we've got the same market conditions, or very similar market conditions for here to what we have here, which is an inflationary time frame. And then another thing that drives this is currencies. So when you price, so everything's in a ratio, whether people like it or not. It's an asset versus something that is priced in a currency. So your currency, your denominator, is really what's driving a lot of this. So this is platinum priced in USD, which is up in this upper right here. And what you want to look at is you want to say, okay, what is the dollar going to do? Now I'm going to use the DXY. This isn't the ultimate value indicator. It's just priced against other currencies. So this isn't absolute value. It is a relative valuation. You can see that we turned over, and that was in 2002. And then we went all the way down, and guess where it bottomed? 2008, and then ultimately 2011. Does that look familiar to, say, what gold and other commodity bull market did from early 2000s to 2008?
It's pretty
Well, it was your
much the same thing
currency.
flipped.
Yeah, it's your currency. Currency's eating 2008 because you get returns in dollars. And if your dollar is going up, well, now you've got returns and a currency exchange rate that's on top of it. So money floods into uh, uh, United States equities, and capital comes in because of the currency exchange. Now, I'm watching this like a hawk because I'm expecting this to eventually roll over. That rollover of the dollar, I think, will give extra boosters to emerging markets and to commodities. And I think gold is anticipating that exact move. That is our leader, so to speak. Another, more evidence for me being potentially right is when you start to price commodity currencies against each other, against the United States dollar. And what you see here are similar patterns. You get the 1, 2, 3 consolidation in a falling wedge. There's that 2002 bottom and the breakout higher. You've got the 1, 2, 3 consolidation, and notice it looks almost exactly like platinum, very similar. And then we come to the corner here. We've been going sideways. We haven't broken out yet. You can see that we've been tracking sideways because the dollar has been strong. And gold's been ripping irrespective of the dollar. It's almost anticipating a potential move. Now, this isn't the only thing to look at. This is the Canadian dollar versus US. We can also look at the Australian dollar. Interest rates, what did Powell do? He shot them to the moon. And those interest rates increased the strength of the dollar and held this down temporarily, in my opinion. And we were just getting a breakout here. And what happened recently with the dollar? We had a strong move. There's the move there. And I think he knows what he's doing. So they're playing currency wars, so to speak, so he can hold down the commodity sector. Now, here's the problem, or the tough part that he's going to run into. He's playing this, and currencies are going to start to move around on each other. When you increase interest rates and you strengthen that dollar, you can only do that for a period of time, because what will happen is you run the risk of weakening the economy. Mm-hmm. You could get a potential slowdown. So I think what they're doing, and this is smart of them, I think they're running high fiscal spending, but in the same time, they're trying to keep rates high to hold this all in check for however long they can do that. So they're stimulating in the back door money printing, and they're holding the interest rates higher, and trying to, I think, delay this big move. If he takes his hand off of the interest rates, like if these interest rates eventually roll over, I'm just looking at the 10-year here, and it very well could. I'm not saying I know the exact path, but if this rolls over, I think the dollar is going to roll over. And if that moves, it's going to cascade into all of these big currency charts breaking to the upside. It's going to be the same relief valve. So think of it as pressure is building in the bond market right now. Pressure, 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 interest rates higher, higher, higher. It's dragging that dollar up with it. And then when he says enough's enough, we're going to do QE and hold that bond market, bring the interest rates down. That pressure is going to change. It's going to be a relief valve. The relief valve is going to be the currency. And when that currency does, gets weak, the Canadian dollar gets stronger against the US dollar. That is what's going to happen. And all of these are set up for that to break out, all of them. Australian dollar, Canadian dollar, the Brazilian real has the same setup, this big three falling wedge, and we've just broken out, and interest rates and strong dollar have held this thing down. When this reverses up, and I can't tell you the exact moment that will happen, that pressure is going to be, you're going to see a money rotation event, a capital rotation event. Gold is front running the move. So gold's our leader. It's running up, anticipating, I think, what this is coming.
Well, for my own sake, I do want the Brazilian real to get very, very strong in the next couple of years because I still have investments there. But let's just take a look at this, the conclusion from what you're showing me here. So I think that a strong theme for the last, I want to call it 12 months, maybe longer, is that we're seeing commodities do fairly well. I mean, the move in gold to me has been spectacular. Even back when it was just trading sideways, the fact that it was trading sideways for so long and just building that gorgeous base was really something. Especially with with what was going on geopolitically at the time, whenever that was happening. And then when you look at the different currencies, and we haven't even gone too much into oil, but that plays a part as well. I'm thinking, okay, if the dollar is about to roll over and foreign currencies are, about to rebound on that, then does that still mean that gold equities or commodity related equities will still, drag behind the commodities? Because that's the theme that I've been asked about just constantly, like uranium's moving, how come the equities aren't? Gold is moving, how come the equities aren't doing nearly as well? The whole purpose of buying these companies is to get leverage on the commodities, right? How do you, play that? What's your view?
Yeah, so I think when this dollar drops, the commodities are going to rip. And then the equities, yeah, they're supposed to have leverage, but I think what's occurring is that money isn't seeking commodity equities at this exact moment. They're all stuck in the United States dollar equities, S&P 500, technology companies. That's where everyone's at still. And that money keeps feeding over there. In order to kill that, in my opinion, is you need to get the dollar to drop. Because what's going to happen is the incentive to be there in overvalued sectors or companies with a dollar dropping is going to cause people to look somewhere else. So this is my opinion here. I think the bond market is getting a lot of selling pressure. United States bond market. Yields are going up, bond prices are going down. That money has to rotate into something. So that money's been going into technology stocks. It's been going into the S&P 500 here recently. That doesn't mean it will last forever. The money exists. It's in the system. It's just in those assets at this time.
In fact, by definition, it doesn't last forever.
Yes. And when that dollar rolls over, the money's going to start to rotate, in my opinion. And that's where I think the equities will do incredibly well. Like I don't even think we've really had a big move in any of the equities that I think might be coming. I know some of the oil companies have gone up 20, 30x. Yes, off of its absolute bottom, they were decimated. I don't even think the big moves come yet. Like I think we're still putting in a bottoming pattern. And that bottoming pattern is the right-hand shoulder of a huge inverted shoulder head shoulder. So it's a big pattern, and I can show that just so you guys can visualize what I'm talking about instead of me. So I think this is XOP, which is just an ETF. I think that this is actually, and I didn't, for some reason, these things flip back and forth. So this is a shoulder. We have a head, and then we're scribing out the right-hand shoulder right now. We haven't broken out yet. Here's logarithmic to kind of, amplify the moves down here. So I think that this is one big bottoming pattern, this whole thing. And eventually this will work its way on up out of it. And what's going to cause that is the weaker dollar. It's all of these being priced in a in a dollar. And the dollar's been strong here on this side of that shoulder. So another way to look at this, and here I'll just put up U.S. oil. I'm a mega bull, guys, so don't get too crazy here. I'm
Oh, good. Most of us are.
yeah, I'm like a mega bull in oil specifically. So remember those fractals that I talked about, the consolidations. This was a consolidation here. You can see that kind of three hump consolidation. We had another consolidation here that ended in 2020, the absolute bottom. The big bull markets occur when you get out of these consolidations. So you break out of the consolidation, you generally get a retest, and then you get the big move. You get the consolidation here, you get a breakout, and then we're doing a retest of the breakout right where that circle is back here. Let me get that all out of there. So that circle is where I think we're at previous bull market. Another one here, this was back in the 60s. So we broke out in 68, came up, and this one didn't have a big pullback. It just kept going. So what I think is coming is something on the lines, and I can show you guys exactly what I mean by this, is this move here is that move there. If that can visually
Wow.
see that. And I think we're
Hmm.
actually going to go somewhere like $700 a barrel.
Which
And
is
people are going to
30,
say,
2032.
well, yeah, maybe something like that. It'll be early 2030s. Maybe it's something like this.
Hmm.
It's tough to get it perfect. It could be 2029, 2030. That would be my guess.
Hmm.
2030, in that area. And I think we'll probably go in $500-600 a barrel. And I
That's
know people
insane.
think that's crazy.
That sounds
They're going to be
crazy.
like, how is that going to happen? What I'm going to tell you, it's from the value of the currency. Has nothing to do with oil. Yes, we could squeeze a little bit in
Gotcha.
oil on the supply demand, but when you create currency, you're squeezing oil because oil is the number one commodity. It is the realization of that credit coming into the system.
Mhm.
So gold is the anticipate. This is anticipating the money creation event. Oil is the lagging movement, which hasn't moved because that's the money coming through the system, if that makes sense.
Yeah, it
So the
does.
money hasn't made it into the system yet. They're
Hmm.
creating the money, and it takes time for it to flood through the system. Right now, they're passing it through Ukraine and paying themselves all, these ridiculous sums
Hmm.
of money, government officials, and whatever the heck they're doing with it. But yeah, I mean that's what's coming in my opinion, and that's kind of what I see, and you can see it in this chart too. That's your consolidation, big moves coming. I don't
Yeah.
know if we have a downward move in the short term. We've been moving a little bit lower. We're at $67 ish, but we could still go down a little bit further and still be okay. We could go back into the low 60s, even in the 50s. I don't think there's anything that they can do to stop this move. That's how strong of a bull I am. Even if this comes down and people think this broke out, it's just going to slingshot in the opposite direction. Like I don't think there's anything they can do to stop it. In order to keep the system alive, they must create more currency in ever greater quantities. And this is just a measuring stick of the devaluation of that currency or dollar. So that's how big of a bull I am. I just don't think they can, unless we find a lot of oil and they can bring on oil.
Those numbers are absolutely insane. And so when I think about something like that, I kind of get excited if it does happen because you'd love to see something just so, earth shattering happening in the markets and being able to capitalize from it. But at the same time, I don't want to know what an economy looks like when these are the prices that we're looking at and how much devaluation there would have to be for the dollar to be so in the dumps for that. And I mean, for any mining company in the world to work at those numbers, then all the prices for commodities must be absolutely astronomical to follow that.
So you got to keep in mind though, mining companies make money off their margins. So if oil is going to that, and obviously all the commodity prices will go up, the easiest, least risk way to play this is to buy a bunch of physical metals because the cost curves are going to go up with it.
That's what I'm
And the
thinking.
price will
That's
be
what I'm thinking. Like
demand
that
destruction.
miners themselves would be in deep trouble because, like if oil leads that, then there's a massive problem because all of their operations would become just completely in the red.
So when you look at the mining companies, just if you guys are viewing this, go look at their, it's called the all-in sustaining cost, AISC, and watch how that moves. We're seeing gold miners go up, 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 up. They just keep going up. And I thought technology is supposed to get better and reduce those costs, but that's not what we're seeing. We're seeing inflationary input costs continue to go higher. And maybe in the future, there are ways to lean that out and reduce costs. I'm not sure with artificial intelligence and other things. I look at this big picture and I look at well, how is the least risk way to play this with the most upside? So think risk reward or reward divided by risk. And the most lopsided are the physical metals because there's no risk. There's like zero risk on that side. You're not going to get a mine that gets nationalized. You don't have inflationary input problems, costs. You don't have CEOs trying to do things that maybe they're investing in Formula One and they don't even have a mine to produce any sort of money from next gen.
Yeah, I was gonna mention names, but that's okay. You did it. They're not a sponsor,
um,
so you're okay.
okay, good, 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 good. But yeah, you've got way less risk there, and I think you've got a ton of upside. So physical silver, physical gold, physical platinum. Yeah,
Would you say the
it's a
same
good.
thing about oil though? Because I mean, it's nice when you get dividends and stuff like that. Or is there
Oil
too much
is
of
a
a risk when you go for the oil companies?
no. I think there's less risk in oil because they already have the infrastructures all built, and like uranium is super risky. Like that's like the peak of risk because they don't have the infrastructure in place. The majority of those companies, they're all speculative. And then oil, like these guys are just tripping over $100 bills, and they're buying back shares, they're paying dividends. It's like, oh my goodness, this is just ridiculous. Now, if the price goes up of where I think it's going to go, they're going to be they're going to be killing because they have everything in place and they've got really good management teams. They've got smart individuals because oil is a much larger sector than mining, most of the miners. So it draws the best talent. They pay the most for the CEOs. If they have the best talent, it draws a lot of engineers there too because you get paid more. And I think that they are going to absolutely just wax a lot of different sectors because they have the infrastructure in place already. They've got the know-how, they've got the people, they can scale it, they've got properties, they can grow it into some areas, can grow and grow their production. I also think that they are the closest to the money printing of anyone. So oil's the number one commodity. It's also the most easily used across everything. So I can substitute palladium with platinum or platinum with
Mhm.
palladium. I can substitute different designs. I can do all these things to kind of get away from copper or something that I can substitute and do something differently. Oil, it's like, do you want energy or not? And it's like, yes. And you can use it anywhere. I also think it's probably the most undervalued commodity in the world. And this is my opinion. Some people say it's silver, and I would disagree. It's definitely oil. Someone will say, well, you can use silver silver is the number two commodity in terms of its uses, which is great. But oil, like if you think of it, it's like, okay, go dig your silver up out of the ground and go get it at ore grades that are at the ore grades that we are today. And they'll say, there's no way. You know how much this would cost to get out? And you're like, okay, so oil is what unlocks everything in this world. It unlocks low ore grades in the earth. It unlocks all of these different things. And then if you say, okay, go dig that out of the ground and see how much you can get, and they'd be like, well, that costs hundreds of thousands of dollars. I'm like, yeah, that's what one barrel of oil gets you. Hundreds of thousands of dollars worth of work from that energy. So I'm in the camp that oil and its ability to be right next to the credit creation. So credit gets created, that's inflation. It comes into the system. when you want to raise GDP with it, it puts everything into a shortage. So credit comes in, it puts everything into a shortage, and oil's the thing that unlocks that shortage to increase GDP because it's so correlated with GDP and oil, that energy.
And it's in all
So I
parts of
think
production
oil's
in all industries. That makes sense. So, do you have a favorite subsector or jurisdiction when it comes to oil?
Yeah, so I'm a little bit different. I'm like the oddball. A lot of people say offshore, go to offshore, and it's like, yeah, I agree, offshore's good, but I also like onshore. Onshore looks fantastic to me in certain areas, specifically Canada, Middle East. People forget that, oil's not, it's not just oil. You've got natural gas too. So natural gas, we have to drill for natural gas, and that just doesn't come flying out of the earth, magically. So we got to go drill it. And usually a lot of that is onshore. So onshore Middle East, onshore in South America, onshore in Canada, all great. And I would play both onshore and offshore. So energy service, I think, will do incredibly well. We've got absolute vertical demand for natural gas and electricity generation. It's going to come from natural gas in the short term, in my opinion. Maybe nuclear's out 10 years or something like that. But in the short term, natural gas. So natural gas exploration production companies in America, and Canada, which is the cheapest. They're going to build LNG takeaway capacity for all these, and then we'll see how much we can produce of this stuff in terms of natural gas. So a lot of people think that we can just, money is going to be the dictator of producing this at an infinitely high rate, and it's like, we'll see what we can do because price is going to go up, and then we'll see how much we can produce. Canada's got a lot of spare capacity, but we'll see what America can do in shale.
What do you think is the simplest, most straightforward way of getting exposure to natural gas?
The exploration production companies, and then the onshore drilling companies. Those are the two that I really, really like.
Interesting.
So that's where I would go, and I would research those.
Got some homework.
And they're down right now. They are down,
I
and they
love
could go
buying
down a
stuff
little bit more.
that is down. If their chart absolutely looks like crap, then that's the stuff I want to buy.
Yeah, I mean, I don't want it to look too bad. I want it to be like putting in like a double bottom, like
Exactly,
some sort of
exactly.
bottoming,
But
the
yeah,
right hand
bottoming.
shoulder of a.
There we
Yep,
go.
like they're showing a bottoming. Um, there's a lot of other sectors that people don't talk about either. There's
Let's
iron
do
ore,
it.
there's steel, lithium is bottomed, I think. So there's other sectors I
Lithium,
think
I'm
really
looking
good.
at some lithium plays that were like the hottest thing 18 months ago. And you look at the market caps, you look at the chart, you look at what they've been doing in the last, year or so, project development wise. And there's just some very obvious plays. Like, do you have anything to say about that? Or are you
I'm
moving
already
into
positioned in
lithium?
them,
Okay,
right? I try to buy right at the bottom, and I'm just sitting in them. And some of them are up like up over almost 100% off the bottom already. And
nice.
I just bought them not that long ago, a couple months ago, I would say,
Mhm.
and they just rock it. Now there is risk there. They're all developers. None of these are huge producers. So I got the ones that are developers in America that have the big reserves. I'm doing the same thing in gold and silver. If we want to produce more silver, like here, I'll just make a quick comment. The way that I view the world, everything's a derivative of oil, just everything, because it's all mined and changed. And then another thing is if we want to go to the world that everybody wants to go to out in the future, how do we get there? And we're going to have to build so much stuff, and that requires concrete, it requires steel, iron ore, it requires all these things. So if we want to get to the world that everybody thinks that we want to go, we got to build like mad, and it's going to take a ton of energy, and it's going to take a lot of steel, iron ore, a lot of commodities and components to do it. So when I look at this, I just look out there and I say, okay, what did incredibly well when last commodity bull market when China was building out? And I mean, steel, iron ore, some of these companies went up, they went up between 20x and 200x in a 5-year period. So what we're doing is if you can look at some of these companies and you get early entry points, you got to be patient. You can't be impatient. It's not going to go in weeks or months. It's going to go in years or maybe even a decade. You get these super early entry points, you just sit them. And it's like, okay, let's wait and see what the dollar does. We've got all these positive technical signals with currency exchange rates, with the fractals in oil, the fractals in all of these different commodities. They're all roughly the same. They're putting in huge double bottoms, inverted head and shoulders. You dive into the companies themselves, they're all putting in bottoming patterns, like all of them, not just a few. Like the good high quality stuff is putting in bottoming patterns. So then if you look at it and you apply some of these Jesse Livermore, quotes and things that people have learned in the markets, all I'll say is the big money is made by sizing up the move. And if you can size the move up properly and get in early and be able to sit and wait and hold during the entire commodity bull market, that's how you're going to make your money. And I'm not talking, what people don't understand is how big the move could potentially be. They can't envision it. They are linear thinkers. Linear thinkers are people who extrapolate, they look backwards and then they extrapolate forward in a linear way. So
Most
60-40
humans,
portfolio did well, and we'll
normal
just
people.
keep doing
Yeah.
that.
Yeah.
I'm not a linear thinker. I'm like the opposite and more of a looking for the turns. I think the turns already happened. And now it's like, this is going to be game on. And if you can be early in that turn, when I mean by you're going to make Peter Lynch's returns look bad, I truly believe that. But in order to do that, you have to apply everything that those guys have learned. You have to learn, Warren Buffett, in a lot of the quotes that he would say is the stock market transfers money from the impatient to the patient. People know that. Mm-hmm. Peter Lynch will say something like, people need to hold stocks long enough for them to actually give you a big return. You can't sit there and trade in and out. You can't do all this crap. So what I'm showing you guys is I showed you a 45-year pattern on silver, and it just broke its handle. That's like earth-shattering in my opinion, because I've been buying in 2023 some of these small junior companies that were like dragging on the bottom that have huge, huge fractals. Now I'm up 250, 300% off that bottom purchases. Now my average, since I didn't buy perfectly at the bottom, I averaged into it all over the place. So maybe my total up is 200% and my best purchases were up, 300% or something. That's how you kind of have to, I think, approach it. You got to lengthen your time frames out. You got to identify the big move, and it's going to take a decade versus months or weeks. I understand why people probably want to get rich quick. I totally get it. They're going to have to go to a trading mentality, a gambler mentality, and you're also going to have to add a lot of leverage. But that puts you in a lot of risk. And what's going to occur is they concentrate their portfolio in one sector or only two sectors. And those sectors could be correlated. So what I see a lot of uranium people do is they go into super high risky stuff and then they concentrate like heck and they put all their money in uranium into a lot of, a ton of risky companies. Risky to me is not permanent capital loss. It's the probability of getting an outcome that you want or desire or expect. And if you don't get that outcome, people get pissed, they get mad, they get frustrated. And that is an outcome of not having a good strategy, in my opinion. So they get mad with the sector, they get mad with the companies, they get mad at people talking about it, and then they start to blame other people. And
it's everybody else's fault.
Yeah, it's everyone else's fault. Somebody said that uranium's good, but that's what I'll say is like you've got to look at your strategies here. I was listening to Manish Pabri. He studies Warren Buffett and Charlie Munger. He has a lot of really good things to say, and I think he's drawn to the conclusions from those two that I drew a lot of conclusions on my own, and then I realized that they implemented a lot of this, and they talk a lot about asymmetry. Asymmetry is what makes the big money. Asymmetry means that you get a ton of upside potential return, and you've got small downside risk. So you're buying these things very early. You're sizing the big move up for the company. They do it for companies. I'm doing it for sectors and commodities. And then you have to hold to realize that big move. And you have to hold and hold and hold and be able to value assets, and eventually see the cycle where you get out at the end. When they talk about this, they talked about their success rate. Their success rate is really low. It's under 30%.
Wow.
Under 30%. So they're losing on the majority of their picks. I think I'm beating more than 30%. I'm probably like 75% or 60%, whatever, which is incredible. And I didn't realize that. So these guys, what carried their portfolios was the symmetry. They had 100 baggers and 1,000 baggers in their portfolio. And I'm like,
More than
Jesus,
makes it
1,000
up.
baggers? So they were holding these things for 20 or 30 years, and they would go up just ridiculous amounts. So they would turn a small amount of money into tens of millions or hundreds of millions of dollars in that position or more. And that's where I'm like, oh my goodness. I mean, that's the key, to understand the asymmetry and how that works in your favor. So a strategy that a lot of people, let's pile all into one sector. And what if that sector doesn't work out the way that you wanted to in the time frame that you fictitiously made up? What I would say is spread out amongst all these big asymmetry sectors and areas. And if the world that's coming is going to be commodity rich, why don't I own a little bit in, like the best 3 companies in like 10 different sectors? So I've got 30 companies, 40 companies, maybe I've got even 60 if I want to sprinkle in some high speculative stuff where I don't want to put big positions on. And then just let them go. Just let them go. And then the market conditions are going to go up for gold and silver, and then it will pause, and then crude oil is going to take off, and they'll just go up and down, against each other, making higher highs and higher lows. So balancing that portfolio using all these different sectors will do wonders for your psychology too. And so you need to know what does well and what doesn't do well, and what kind of offsets each other, just to keep you sane, so to speak. Because some of these, I mean, they go up and down like 20% in a day. Some of these sectors and some of these companies. So psychologically, it's real hard to hold on if you're not used to that.
That's very true. And on that note, how can people find out more about the secret stuff that you have going on for a few select individuals there? Let me know how to join your group and figure out all these things that you're putting out.
Yeah, I mean, obviously you can join the website finding-value.com, or you can follow me on YouTube, Finding Value Finance, which is down there. I go into all this. Yeah, I don't know how people can only look at the world through either technical or only through fundamental. I do both. And what I try to find is I try to find these big fractals, like we saw in silver there. You can find those in the companies too. And then you can dig into the fundamentals and you're like, ooh, they've got a lot of really good stuff. And that's your entry point. That's your good, stock pick or whatever. And just sit in it and ride it. It's easier said than done. The easiest part's buying it. The hardest part is sitting there and not looking at it and holding it, for most people.
100%.
For some weird reason, I don't have that gene. I kind of just like, I get aggressive when I need to, and it's a learned trait. You get aggressive when everyone's telling you that it's bad, and why are we investing uranium? And that's when you should be loading up, is when everybody's telling you it's the worst investment ever. So a lot of it's sentiment driven too.
I think so. I think you need to be. I think there's a little bit of a personality trait that you need to have to buy when it's low. And I think that if you have identified that in yourself, and if you're listening to this, then jump on it, because that's your edge, I guess, in a sense. And you'll learn it when you talk to other investors, and they've given up on a thesis, within 2-3 months, and you're sitting there going like, what? I'm still looking for deals. I'm still, investing more into this thesis because it just hasn't played out yet. And so when you figure that out, then, that's a good thing, because you do your homework, you make a decision, but once you make a decision, it's more about just watching it and seeing how it develops. So that's awesome. So any last words there, Andy, for people who have too many things to invest in now, because you've given us too many ideas, and that might be
I'm the most bullish in commodities, and I will say this to everyone: it is the hardest to hold because they're the most volatile. Decades happen in years, so you can take advantage of that when these things really start to go. You can find great companies that are really, really low that has nothing to do with the company. So when you look and you apply, commodities are different because the commodity determines the margins of the companies. When the commodity falls really low, you can buy really, really good companies, well-ran companies for pennies on the dollar. I can't find that anywhere else in the market because if you have a really well company that owns and sells a product and controls the selling price, they should never go to almost zero. They should never be 99% off their all-time highs. But in commodities, you get to do this and you can cycle through it faster.
It
So you can
happens all
get
the time.
Peter Lynch type returns that he did over 20, 30 years. Some of the companies I went in, I did a Peter Lynch return in only a couple years.
Oh,
And that's where it's like, holy smokes, that's where the opportunities are. And I get so drawn to the commodity sector because of that.
that's awesome. Me too. Me too.
Yep.
Good stuff. Andy, thank you so much. You'll be back on this channel because I love having these conversations and I get hyped up for sure. And now whenever we have this type of chat, it always kind of gives me the feeling that I don't have enough cash because it's all deployed. And then I'm like, I need to just make more money so I can just buy more of this stuff. But thank you
Boost your
very
mindset.
much. Yeah, I thank you and hope to catch you very soon. Take care.
All right, see ya.